I haven't really done too much, but I actually am very pleased with the composition of the market. Yesterday, the breadth wasn't so good, and a lot of us were complaining about that. Today, it feels a heck of a lot better because it was technology, and it was, as you mentioned, cyclicals as well. So the thing is now we're getting more clarity, and investors want more clarity. It's on the elections, it's on the makeup of Congress. And if we get gridlock, it's okay. Again, from an investor point of view, we don't want big surprises. I don't want drama. And we didn't really want, from a corporate point of view, we did not want higher taxes and more regulation. So all those things are fueling the rally for sure. But the one thing both sides agree on is fiscal stimulus. And that's why I think cyclicals are rallying, because we're going to get it. It's just a matter of when and the amount. It's going to be less than the $2.5 trillion that if it were a blue wave, we would have gotten. But we're still going to get $1 trillion or maybe even north of that. And that's good. That's positive. So those are the things I'm keeping my eye on. And Sarah, by the way, I think one thing that's getting totally ignored is earnings. Earnings have been terrific. Last 24 hours alone, we got Expedia, Qualcomm, we got Cardinal Health, we got Bristol Myers, Zoetis, Parker Hannifin. It's very, very broad-based, and that, too, is very encouraging.
Mike, two risks out there, perhaps, that the market is ignoring at the moment. One is that a blue wave is still possible, that we could see the Senate not go to the Republicans, as many people have been talking about over the last 24 hours. The other is rising cases here in the U.S. If the market starts to focus on either of those, could that take the wind out of the sails again?
Well, the first risk would only happen in early January when those runoff elections occur, most likely. So it seems like the market's not going to panic in advance of something like that, and it would be a one vote majority. I don't think that's necessarily today's business. In terms of the COVID case surge, there's no doubt about it that the market is seemingly taking the view that it didn't feel smart to panic out of the market back when we saw the previous surge. Whether we got lucky or not, or if it's going to be worse now, there's going to be a slowdown effect, it just didn't seem as if that was the way to play it. So maybe that's why the market's showing an ability to look through it. Yesterday was very much a stay-at-home big tech type feel to it. You almost had the sense that that was going to be the mode, but that has not really carried through today. I see the action. This rally is a lot of people caught a little bit off sides, either just being generally underinvested if we're going to have some kind of a push toward a fourth quarter rally, or just in the wrong stuff. And having to grab at it today. So I think there's a little bit of a positioning shock that is behind this very strong week so far.
Shepard Smith here. Thanks for watching CNBC on YouTube.